Thanks a lot for joining us, and I wish you a good day, good morning, good afternoon, whatever time it is where you're watching us today. And I want to welcome you to our webinar, which is entitled Winning in Difficult Economic Conditions, How to Ensure You Stay Profitable in a Rapidly Changing Environment. And this webinar is being run today in partnership with Provenir, who I work for. And Provenir provide platforms to give you the ability to detect bad credit or fraud issues across the whole customer life cycle. And our other partner is FinTech Istanbul, and I'd like to thank them for their help in arranging this webinar. I have the great pleasure to be joined by two fantastic guests who I know personally. So Cenker and Hakan, a real pleasure to spend this next hour with you guys. I'll give you a couple of minutes to introduce yourselves. So we'll go in alphabetical order. So Cenker, over to you first.
Thank you, Corinne, and thanks for the invitation. So my background lies in telco and credit risk. I spent some time working for a telco operator, a mobile operator in Turkey. Then I joined Experian back in 2006. I was initially tasked with setting up the Turkish office, which led to expanding our footprint in the Middle East through opening an office in Dubai and hiring a team. I spent 10 years working for Experian, managing in my last couple of years Eastern Europe, Turkey, and the Middle East. Then I moved on to working for the credit bureau in Dubai, Al Etihad Credit Bureau, and later joined Iron Mountain, offering solutions to banks and financial institutions, also managing Eastern Europe, Turkey, Middle East, North Africa. So I've spent a great deal of time in this part of the world, offering solutions to the financial institutions. Over to you, Hakan.
Thank you very much. Hi. Thanks, Corinne, for having us here. So I started working in financial services in the year 2000. So it's been more than 23 years. Started with HSBC and UniCredit for the first 5 years, and then moved to Experian Turkey, just like Cenker, but 1 year before him. It was a time when everything was picking up. We, like 3 or 4 people, we built the first ever used credit risk models in Turkish banking sector, and then implemented all the decision engine software to the majority of the banks, which still use plenty of them. And 5 years later, I moved to Barclays Bank in the UAE, where I was held responsible of retail risk management activities for 13 countries that Barclays was operating, of 10 of which in sub-Saharan Africa, plus India, UAE, and Egypt. And I moved back to Turkey then. And for 10 years, I worked for 3 biggest retail banks in Turkey: Garanti Bank, Akbank, and Yapı Kredi, in order. And in these places, I worked on infusing the analytics culture, the data-driven decisioning culture into day-to-day operations of the banks. How can we make the most out of data? How can we use it in our day-to-day operations? And how can we improve the credit decision quality in every decision we take? So I worked as Chief Analytics Officer, Chief Data Officer, and head of retail lending and credit analytics and roles like that. And last year, me and my 2 partners, we found Mindberg AI, a decision science and technology company, where we still continue to tackle with business problems of companies, not only from financial sector, but also from different sectors which have enormous data and trying to improve their decisioning with this data. To give an example, the maritime logistics companies or textile industry machinery companies we currently work with. Yeah, this is it from my side.
Thank you very much. So, like I said, two fantastic guests with a good track record and lots to tell us about today. So, as we said, the title is about winning in difficult economic conditions. I spend most of my time working in sort of mainland Europe, so very different conditions from what you guys are seeing in Turkey. So I think, when I'm thinking about sort of the trends that are impacting lenders and financial services in the countries that I work, I think we're seeing things which are seen as very difficult in our area, but I think compared to what you guys are seeing in some of the areas you're working in, the banks and financial institutions are having it quite easy. But I think from my side, the sort of trends that companies are seeing, that financial institutions are seeing, is that we've been in a situation of reasonable stability for literally hundreds of years, where banks have had major monopolies. They haven't really had any competition. It's been very difficult to move from one bank to another. And then the EU came along and created some nice legislation. So we've seen PSD, PSD2, and now we're starting to see a PSD3, which have really revolutionized, the hold that banks have on their data. Which has, changes from sort of a very closed ecosystem to an ecosystem which is really expanding and exploding, which has meant, significant competition coming into the market for these very, very established traditional banks that have, seen not an awful lot of waves of competition over a very long period of time. Lots of new products opening up because suddenly there's new data available, new ways into the market which just didn't exist before. Lots of new technology coming into the space. So, we're able to do a lot more around personalization and, making offers much more tailored, much more relevant for people, rather than, this is it, take it or leave it, because you have no option apart from going with us. Those days are over. And also, we're seeing a lot more players coming into the finance space who aren't really a finance area. I know, Cenker, we were talking just before this, and some of the very people you're working with now, are good examples of this. So, I mean, Cenker, from your background, I know in the Turkish market, probably what I've just talked about sounds very easy to manage, because I know, some of the trends you're seeing in that market and wider go a lot more difficult, a lot harder to manage.
Thank you, Corinne. I think challenge is the name of the game in this part of the world. And you mentioned, what I will summarize as open banking. And back a decade ago, open banking allowed third-party providers have access to financial data, and the consumers had the opportunity to use customized products, more affordable products. So thanks to open banking today, banks and financial services institutions are building sophisticated products. Obviously, a more recent trend these days is based around artificial intelligence and machine learning. Although relatively new, these technologies are already being used by the lenders and other financial institutions to automate tasks such as underwriting loans and detecting fraud. But AI and ML are also helping personalize financial products and services for consumers, which is getting more and more traction as consumers are preferring to work with institutions that offer them personalized products and services.
Yeah, I think this is the thing, isn't it? When you live in a world where, I can switch on, I use my telephone and my telephone tracks what I'm doing. And then as a result of that, offers me things that are specifically angled towards me. That expectation transfers into other areas of our life, doesn't it? So,
yeah, which is a great segue to my next point, embedded finance, right?
Yeah.
So as the name implies, this is integrating financial services into non-financial platforms such as e-commerce sites or social media apps. So it allows the consumers to access financial services without leaving the
Yeah.
platform, the existing platform they use.
And I think that's a really great way, isn't it? Because you know, those embedded, where you've already got the trust of the customer on that platform, and the platform provider can add a finance part. You know, I as a customer feel very at ease doing a financial transaction because I already trust the platform. So yeah,
absolutely. And it's great for consumers because they now can have products or services like buy now, pay later, and even offers through challenger banks, which are like mobile first banks that offer various financial services through the app, which is not a good news for, you know, traditional banks, but where there is competition, there is a benefit for consumers, right?
Yeah.
And my last point will be around, you know, in terms of trends we are witnessing, will be around financial inclusion.
Yeah.
So this is about making financial services accessible to everyone, regardless of their income or background. It is important because, you know, as economic headwinds create additional challenges for economies and consumers, it is important to help consumers to improve their lives and reach their full potential. And coupled with the increasing rates of immigration, especially in or around Europe, I think this is going to be even more important in the next couple of years.
Yeah, and I think there's two really important points there, isn't it? Because like you say, the financial inclusion, and I think, you know, we'll talk about that in a bit more detail later, but it is a really important point. And you know, the change in the ecosystem that we're seeing is really enabling that to happen a lot more. And I think, you know, that point about migration, especially, you know, within Europe, because, you know, one of the ideas of, you know, Europe was freedom of movement, freedom of labor, and all the rest of it. And it is very difficult when, you know, you have a very good solid credit record in one country and then you move to another country and suddenly you can't do anything. And, you know,
Absolutely.
you're there, you know, you need to get a new mobile phone, you can't get a mobile phone, you know, you need to buy a house or rent a house, and, you know, all of these really basic things become very difficult. So yeah, I think
it's a new challenge for the lenders, but
totally.
Also an opportunity, right?
Totally an opportunity. Yeah, totally. Hakan, from your perspective.
Well, I think we're in the middle of a paradigm shift in banking, just like in many other sectors. The shift is from the bank-centric services to customer-centric services, right? You know, the bank's approach was, okay, we have 10 million customers, we have 1,000 branches, and 3 other channels as well. So this is a number of products and services that we should be selling this year to have a successful year. And these are the targets accordingly. See you in 3 months and we will check. Go get it. But for the last 6 to 8 years, they're working on their transformation to execute as a customer-centric service providers. And of course,
which they've had to do because of the competition coming in, who you know, forcing them to, like you say, losing that power base and forcing them to focus more on the customer.
Exactly. I mean, the digital customer experience is at the heart of it. It's at the heart of the customer-centric service, and all the footprints and traces that your customer leaves, we call them data. So the banks have to be data companies. What I call them, the new thing is the data companies specialized in financial services. just like Netflix being a data company, specialized in movies and series and documentaries, or you know, Spotify being a data company specialized in music and podcast streaming. The banks should be something similar to that. So,
I think that's a very good parallel.
With the fintechs, this where the advantage comes for the fintechs. They don't have to transform or move a huge ship from one way to other as fast as possible because they don't have their historical debt on their shoulders. They don't have 1,000 branches to operate. But they have to get organized in the right way, which is not easy as well. So as Cenker said, this the experience motive takes us to embedded finance for sure, because consumer's financial need should be resolved within the same journey, wherever they are at that moment. You know, maybe they're on Amazon, or maybe they're physically at the Apple store. You know, but all those things are they're always easier said than done for all the companies, for the modern new ones, the fintechs, for the traditional banks. It's hard for all of them. It's very hard for the traditional ones to unlearn some of the things that they've been doing for 200 years. Also, it's hard for the fintechs to start from somewhere, to, for example, to start building a customer base, or start creating as many different products as the banks have. So I think
very little infrastructure, very little, you know, with, like you said, a support base which is so much smaller. So
but what I see is this brings us to a point where we see many collaborations and partnerships between traditional and non-traditional companies, which totally makes sense, right? You know, the traditional finance players have the required capital, first of all, and usually it makes more sense for them to invest in a company which is good at embedded finance, for example, rather than going into this area and trying to compete with them without the muscles that they need, without the muscles built for this. So that's what I see in trends.
No, definitely. And it's quite interesting, you know, because I think the other sort of trend that I don't think we've talked about, which is obviously quite a big, well talked about trend at the moment, is sort of ESG, this sort of environmental, social type trends. And, you know, Hakan, you were talking about, you know, becoming data companies, and we, you know, and everything's driven off the back of data. And, you know, we're creating, I know the stats about how much data we create every year are just amazing, you know, it's exponential. But obviously all of that comes with an economic, ecological background to it, you know, because all of that sits on a computer somewhere that, you know, creates heat, creates CO2 and all the rest of it. So it's going to be an interesting challenge, isn't it? You know, with people looking to try and create lighter footprints on the earth, but like you say, needing all this data.
I mean, it's very difficult to, you know, to step on the first stage, which is, I think, awareness, where we are still struggling now, and we will be, I guess, struggling for the next 1 or 2 decades, the awareness of the ESG pieces. And then, but, you know, the banking sector has already internalized it, and thanks to the big funders, they started to divert the capital to be used in the right direction for the banks. Which is very good. And this is but just very small part of the awareness that we should be having in the next following years, I guess.
That I'm sure is another trend that, you know, we will see augmenting as the months go by. So Cenker, from your perspective, it'd be interesting to get your point of view on this. So I've been at 2 conferences recently, one in Germany and one in France, where for both conferences, they had representatives, government representatives, who were giving stats on the rate of lending in difficult economic conditions. And in both countries, the sort of formal official view was that lending has not slowed down. There is no shortage of credit availability. Credit has not shrunk. But it was very interesting to actually see the point of view and the feeling, maybe it's a difference between feeling and facts, but the feeling from companies asking for credit, who really had this feeling that criteria had tightened up. That maybe there were more hurdles to jump over, you know, things like this. So, you know, from your perspective, you know, do you see the economic climate affecting the way that lenders are making those credit decisions and other risk decisions?
Absolutely, and I couldn't agree more with you. There are more hurdles to jump year on year. So it's been a challenging year so far, right? 2023. And since COVID, every other year is becoming more and more challenging. So the economic climate of 2023 can be, I guess, characterized by high inflation, rising interest rates, and slowing economic growth, coupled with geopolitical challenges, again, especially in or around Europe.
Yes.
So these factors are making it more difficult for borrowers to qualify for loans and increase the risk of loan defaults, hence the hurdles.
Yeah.
So let's go into more detail, right? To start with, the high inflation erodes the purchasing power of consumers, individuals, and makes it more expensive for them to repay their debts. And this makes lenders more cautious about issuing loans, leading to more strict credit standards.
And it's tricky, maybe even the people who took out those loans sort of 2 years ago had no problem paying them, but like you say, the things that have changed since that point means that, you know, somebody who was a good risk at the time now is not the case. So yeah.
And a continued investment in new technology and credit risk related solutions and products for the lenders, obviously. Then the rising interest rates are making it more expensive for borrowers to borrow money. And this is making it more difficult for consumers to afford new loans and increasing the debt burden on existing borrowers. And last but not least, the slowing economic growth increases the risk of unemployment and makes it more difficult for borrowers to repay their debts. Obviously, this makes lenders more reluctant to issue loans, leading to higher default rates. So as a result, the current economic climate makes it more challenging for lenders to make credit decisions. Therefore, they are taking a more cautious approach and are tightening the credit standards, which also is increasing the cost of borrowing, right? Well, clearly, the economic climate is a challenge, a challenging time for borrowers, and yet it is also an opportunity. We just talked about it, right? The opportunity for lenders to be more selective and make sure they are lending to borrowers who are most likely to repay their debts. I think it's also important for the lenders to work with the right technology partners, such as yourselves, and make sure they utilize the state-of-the-art technology in order not to face consequences, unwanted consequences of the challenges I just mentioned.
Yeah, no, exactly. And I think, you know, what you said, you know, is 100% accurate. And, you know, if we add on to that, you know, the complexities of the sort of business market, and like you say, traditional institutions who would say, you know, give me 3 years of accounts, 3 years of accounts over COVID, it's like, does the last 3 years really represent what the potential of my business is? You know, so like you say, it becomes very, very complicated, doesn't it? And I guess, you know, Hakan, you know, you can probably reflect a little bit, you know, so, you know, it's all very well talking about, you know, the importance of that point in time decision, do I give somebody credit or not? But, you know, you need to go beyond that, don't you? And it's that sort of customer management, ongoing monitoring that also becomes, you know, very, very important, doesn't it, in this type of climate?
I mean, what I've been observing lately is that the rest of the world, in the Eurozone, for example, is getting more similar to what we have always experienced in Turkey, in Turkey credit market, right? You know, for ages, we had, in terms of the financial system, we were more fragile than the rest, and we had always have bigger fluctuations in macro parameters, more frequent economic downturns because we had some our internal ones too. So never-ending inflation problem, but also, as Cenker said, it's we always had more opportunities, a bigger spread in what we do in terms of business in general. But right now, it doesn't matter which part of the world we're talking about. We can definitely see some stricter lending policies in place. The worldwide fight against inflation, of course, is not as big as ours, but worsening affordability, as Cenker mentioned as well. Affordable levels are deteriorating amongst consumers, and at the same time, increasing regulatory interventions to the various credit-related issues. So the lending is based on the lender's good expectations. You know, you lend your capital and ideally expect each and every borrower to pay you back in in the expected timeline. So,
but unfortunately, life happens, or fraud happens.
Yeah, it's getting harder to make predictions, even for the near future, and manage a lending portfolio accordingly, I guess.
Yeah.
So this, of course, pushes both the lenders and the regulatory authorities to be more cautious.
Yeah.
And as a result, credit becomes less accessible, in my opinion.
Yeah.
A bit contrary to what you said earlier.
Yeah.
But I believe it will be changing in to a better position in 2024 and 25, because Eurozone has taken so many actions, and I think they will see the results. And I think the credit market will be growing, led by consumer and business loans as the economic conditions improve together.
And I think it's it is a real challenge, isn't it, for the regulatory bodies, because banks have been classified, most of them, especially your top four in most countries, as too big to fail. If one of your top four banks in a country goes down, that's a serious problem that most countries do not want to manage. So
it's very hard for the from the regulatory perspective. I mean, I remember the discussions about pro-cyclicality versus counter-cyclicality of Basel, the Basel standards. Like 10 years ago, 12 years ago, we were talking about when the economic downturn is at the age. The regulatory body was expecting the banks to have tighter policies, which was making things worse. So it's not always easy to.
No,
the lending. It's all about timing. You give some decisions and you wait for the outcomes.
Yeah.
So you have to be prepared for the unseen. It's hard.
Yeah, no, definitely. Which is why I guess you're in a job. So that's the challenge, isn't it? And,
never a dull day.
Yeah, never a dull day. That's true. And Cenker, you were sort of referring to some of the ways that credit providers can stay ahead of the competition and see these challenges as an opportunity. I wondered whether you want to sort of expand a little bit on that for us.
Yes, thank you, Corinne. I think it's important to innovate and adapt for the FSI sector and fostering a culture of innovation and experimentation to develop like new products, new services, and approaches to address evolving customer needs and market dynamics will be quite influential. I always emphasize to embrace a data-driven decision-making. But everyone has access to data, right? And everyone is investing in, analytics, AI, and ML technologies. But I guess this is like the true north going forward for the FSI sector. But it's also important to prioritize the customer experience across the customer life cycle. I think creating a seamless and frictionless customer experience across all touch points is really important, and it's very convenient for consumers to have access to mobile platforms rather than brick and mortar branches. Obviously, since everyone has access to data, exploring alternative data sources is going to be super critical in terms of creating this difference between yourself and the competition.
And I think that is really key, isn't it? Because again, it's one of these things that for the last 20, 30 years hasn't really moved so much. And, in most countries, there's been a credit bureau and that's been the source of truth in most markets. And, it creates this very binary type credit population, doesn't it? Either you do have a credit profile or you don't. And if you don't, like you were saying earlier, it's very, very difficult to get onto that ladder. And like you say, the new data sources that are just starting to come out in the next, in the last couple of years are really, again, changing that sort of almost monopoly situation that's existed in so many markets, and opening up, like you say, so many opportunities for lenders to go for new niches. And, like as you were saying, Hakan, to actually go with some sort of confidence because you have some data to base it on. So yeah, really important.
Yeah, great point, Corinne. And obviously investing in digital transformation will also create that edge. So paper has literally disappeared during almost every interaction a consumer can have with a bank or a financial institution. But including AI and ML in automating all the manual processes, adopting, cloud-based infrastructure, and also, using AI and ML in automated decision making is going to be really important in terms of how you position yourself against the competitors. We talked about, collaborating with fintechs, right? Partnering with startups and fintech companies, and to tap into their innovative technologies, data capabilities, or agile development processes, also going to create that competitive edge. Yeah. I think my last point is the most important element, which is to personalize credit offerings. This is what the consumer expects and will expect going forward. Tailoring your products and services to meet the individual borrower's specific needs and preferences. You cannot invest more, every dollar spent on creating that individual experience is going to help you beat your competitors.
Yeah, no, totally. And what you're talking about there, and I think this is, like you say, the challenge for a lot of institutions, because it is a massive program, isn't it? All of these new data sources, it's okay to say that, but you need to bring them into your process somehow. You need to include them in the decision process, work out what the weight of that is. How do you make that as a streamlined, non-friction part of your process? How do you give the customer back what they're looking for? Yeah, so it's one of these things. It's like 5 seconds to say, but millions of dollars and a lot of time and effort to make it actually happen in reality, isn't it? So yeah,
definitely.
Yeah. And Hakan, from your side, any sort of how have you seen the clever financial institutions staying ahead of the competition?
Well, in my own experience, there are two key things that we have to be, when I say we as lenders, to be very good at as a lender in order to stay ahead of competition. Apart from the obvious things, which is making the most out of data and using the technology at its best, etc. But one is to have a good understanding about the behavioral characteristics of your customers.
Yeah.
And the second is, I'll elaborate on that. And the second is surely how and when you will react to economic changes, both in positive and negative changes in the macroeconomy. I think these are really important things to watch out. I mean, in terms of the behavioral side, your credit portfolio is made up of your customers, and your customers' payment behavior don't really change, believe it or not. Not talking about the affordability levels or limit utilization levels based on economic conditions. These are affected by the macroeconomic factors, the interest rates, and the affordability deterioration, etc. But one's payment behavior is more like hard-coded in their personality. So some people tend to be on the saver side of the money management balance, and some people tend to be on the borrower side. So these two types show different reactions to economic changes.
Yeah.
For example, we've just seen recently in our country, in our own entourage, some borrow more in the inflationary economy, thinking that the paying back will be easier and easier day by day.
Yeah.
And some heavily decreases spending, anticipating worse to come after the inflation game. So our current capabilities as lenders in turning data into insights can show us which type of customers we have in different credit product groups, in different segments like consumer loans, business loans. So being aware of this lets you differentiate your lending strategies among these groups. And I think this gives you a competitive advantage. in terms of better pricing in micro groups, or in terms of collection strategies and so on. So rather than drawing thick lines of, you know, auto reject, all these people with this PD and things like that,
yeah,
you can get into details and give much more personalized credit decisions, as Cenker mentioned. So this way you can even market your credit products in a credit turmoil to a selected group of customers
who are going to be receptive.
Exactly, and so that you can prevent your portfolio quality from deteriorating. Not maybe the quantity, not maybe the volume, but the quality. You will need that quality once you come back from this credit turmoil. So, the second thing, what I was mentioning, is knowing how and when to react the upcoming macroeconomic changes. Well, what I've seen is when you start realizing the changes happening in the economic climate, it's usually a little late to take action regarding your credit portfolio as a lender. So, but if you're able to predict what awaits you in the next 4 to 6 months at least, chances are you will welcome the change in the economic climate more prepared. So I'm not saying deterioration only. I'm saying change, because you have to go either way. For the better macroeconomic future as well. I mean, we've seen so many times while getting out of the economic turmoil in Turkey, some banks started pushing the throttle much more earlier than the competition, and they gained serious market share at those times. So, you know, we know the results of the credit strategies, they come in a lagged way. But we should also make sure that we take action early based on our forecast and our predictions, if we want to differentiate ourselves from the competitors. Otherwise, we just follow the crowd and nothing happens. Whatever data you have, some new data, if you do the same things at the same time with the others, there won't be a competitive advantage, I can say.
So the importance of having those forward-looking indicators, as well as the indicators that are telling you of what's going on now, and having the technology that enables you to capitalize on that, to get the most head start on what's going on and what you think is going to happen before everybody else catches up.
I had these debates, discussions, or arguments, let's say, with the banks I worked for. I mean, let's give an example. So say that we are in a very good market, lending is booming, the portfolio is growing, and collection is the least of our worries right now, let's say. But if you don't touch your collection strategies at this stage, so if you don't renew your collection models, for example, you know, change them with some better machine learning models, or fine-tune your collection segments, have a second look at your self-cures and etc. some micro segments. You will be late to do all of those
when you need it.
Still in the economic downturn is your monitoring dashboard. That happens so many times in my career. So some of your competitors will be more ready for and they will collect before you do.
No, exactly. Exactly. And just one example that you know, I'd like to share, that you know, coming back to what you were talking about, Hakan, being able to, you know, mine your customer data, and you know, Cenker, you were talking about, you know, using AI ML to get the most value out of that data. So, you know, me as a bank, I might know that I'm moving from one part of Istanbul to another part of Istanbul because I've made a mortgage application. You as a bank know, you know, this is my new address. You know, you as a bank already have customers in where I'm going to move to. You can use the data, like you say, Hakan, you know what I spend, you know where I spend it. So you can use AI to profile and say, okay, so Corinne fits into profile XYZ. Profile XYZ generally go to this restaurant, get their haircut in this place, go to this gym, take their dogs to dog daycare here, or whatever else, whatever services, you know, this type of portfolio need. And, you know, that is brilliant, you know, because if I move to a completely new area of the city, I might not have that. I don't know, where's a good electrician? Where's a good plumber? All of this sort of basic stuff that you as a bank probably have that information among your data. And you can find it, but this is where, AI and ML helps to get, because, there's a big sort of debate about, where can we use these technologies at the moment, because people very reluctant maybe to use it in a scoring mode because it's not as open, although we can make it open, and all of this. But, in that sort of segmentation area, there's no limit to how we can use it. And these are sort of all the value added services. Cenker, you were talking about the importance of personalization. That's a personalization service that would really set, your mortgage product apart from any other mortgage that I went to. And it's, starting to, rather than just see this as a mortgage application, but see this as, my whole life has been picked up and moved to another place where I don't have the contacts that I have currently, but you can help me with that information. And it's that sort of looking at things in a more customer focused area, that exactly as you were talking about, that I think will make the difference, with the new technologies that we currently have available to us, when we can get all the bits knitted together and make them happen. So yeah.
Yeah, please come back to that later, the use of technology and AI. But I think the way we look at the journey I think is more critical than using the advanced analytics or the complex algorithms to mine data. I mean, it's very obvious that when you pretty much obvious that you're changing something big in your life by getting a mortgage. So your customer, your main journey as a customer is about the change. So you can start from there without anything rocket science, and then do anything you can using your data, make the most out of it.
No, exactly. So we're probably going to talk a little bit more about data now. So Hakan, when it comes to sort of data, what do you think are sort of the main considerations when you're looking at sort of integrating non-traditional data, alternative open banking data, and things like this, to actually make sure that it helps the process? And I think, maybe we can talk about a little bit what Cenker was talking about earlier, about the sort of inclusion agenda that can come into that as well.
Sure, that's one of the favorite topics of mine. So I want to start by framing the answer a little bit in terms of which lenders we're talking about. So because there's always in terms of the traditional lenders, the big banks, there's always a distance between these lenders and the subprime applicants. So in good economic conditions, banks don't have the motivation to extend their lending services to those groups, because they're doing enough business with their existing portfolio, and they don't want to take additional risk. But in economic downturns, these subprime groups seem more dangerous than ever to have an exposure. It's always risky for a big bank to, in one way or another, to include a subprime segment in a bank's portfolio. So I think this is why the fintechs or smaller lending companies are working on these subgroups more than the others. So you could be willing to take risk in those segments for a reason. For instance, you can be a tier 2 or tier 3 bank trying to deal with such segments to gain some market share, because you don't have a really place on the clearer piece of portfolio. Or you can be a fintech that needs to start from somewhere to create a credit portfolio, and you see the segment more approachable because they are more in need of credit.
And companies starting up generally are looking for market share and don't really care about collections. We'll deal with that later.
Exactly. So integrating non-traditional or alternative data, such as open banking data, let's say, it sounds great, but currently, at least in our environment in Turkey, there are some setbacks to tackle before you benefit from such data types in your credit decisions. I mean, first of all, since subprime groups don't easily have access to credit, they're usually non-banked or thin file customers from the bureau jargon, you know.
Yeah.
So you don't know the payment behavior of those, which is the most critical information that you need to have about your borrowing customer.
And this is like the vicious circle of subprime, isn't it? It's like, are these people really subprime, or are they just excluded? So we've never known whether they can handle credit or not. So.
Exactly. And the open banking data, so far, it usually doesn't include the information that will serve as a payment behavior either. So you have to work on that to see some of the parts as a payment behavior. You need to create it out from the data. So in my opinion, the lender will need some time and money to spend to turn the non-traditional data into a precious data, which will include insight about the consumer along with the payment history. So, and how can you do that? Of course, first you invest on such data, do a partnership with an open banking company which has the data or has the skills to integrate those data, without expecting any benefit, in my opinion, for the first almost a year. And that's one of the things that you will spend your money on. And second, you can start a low and growth strategy for those customers. You can give them a very limited credit exposure via a credit card, an overdraft, or a very small cash loan, just to understand the payment behavior with a limited and calculated cost of risk. And this cost of risk is I think it's the other piece where you will spend your money as the lender.
And
so
I think
this
is really interesting for me when I looked at sort of buy now, pay later portfolios, because it was exactly that they had a much higher proportion of subprime in the portfolio, but they didn't have the bad debt that you would expect with that percentage of subprime. And I think, you know, that point of giving people a bit of credit to prove whether, you know, they're just subprime excluded or are they subprime who can't manage. And that's what you need to do, isn't it? Is making that differentiation.
Definitely. And some of the BNPL portfolios, you make them spend to buy goods. You're utilizing BNPL to buy goods, so it means that they're not the in-need customers first of all. So it's quite a bit different from the subprime lenders. So you can see a better portfolio, surprisingly. But I mean, in my experience, in my example, by the end of year one, you can have a portfolio of a few thousand customers with some payment behavior. Along with an additional non-traditional data, non-traditional information and insights that you have from the open banking data. And you can link the payment behavior with that data. So I'm not talking about something very easy, but I see that's one of the good ways to start with as a fintech or as a small lender.
Do you think you can accelerate that process if you work with an open banking provider who already gives you the categorization on the data, or is in that sort of 1 year runway for you, including sort of creating your own internal categorization?
Anything that will serve within the data as a payment behavior will accelerate the process. But if you're going to start with BNPL or some shorter term credit, you can see the results easier than as
your outcome periods are shorter.
It's a shorter term, so you can burn less money in less amount of time, and then you can tailor it to your
the results on your investment. Yeah, that's good. Cenker, anything you want to add to sort of data and sort of how we can use it to, to improve, or the inclusion element that you were talking about?
Well, I think I'm going to refer to Hakan's last sentence about burning less cash. You can use that budget to acquire startups or invest in fintechs as a bank, right? And this is happening recently. It's another way of being able to tap into additional resources, additional data sets, and the culture sort of infuses, right? Actually, both ways for the fintech and the legacy institutions we work with. Therefore, I think, by utilizing data, by utilizing technology, and investing in the FinTech sector, the financial services institutions will be able to sort of finally offer personalized products and services.
Yeah. Yeah. So, and I think if we're looking at the sort of the pyramid of financial needs, data comes at the bottom, doesn't it? And then Hakan, do you want to sort of talk to us about sort of the next levels up? So, if we've got our data and, we've explored traditional data, alternative data, and then, how do we go up the levels sort of, to use sort of advanced analytics, and doing that across the whole customer life cycle?
Oh, yeah, that's a good question, but the answer could be a master thesis. So
is this art or science, Hakan?
Yeah.
But as I said earlier, in banking, as far as I see in the last 24 years, I mean, your aspirations, your business targets, or the complexity of the products, none of them are rocket science. But we're able to see it as simple as it is. I think this is the hard part. So, so I'll give you an example. I'm an entrepreneur now for the last 1.5 years. And naturally, one simple customer of those banks that I worked for earlier. So
yeah, you see it from the side.
I don't believe the experience I have with them. So I'll give you an example. I'm a lazy payer as a microsegment. Okay, so I usually pay my credit card in the last day, or more frequently the day after the last day.
Yeah.
When I paid the day after, let's say 10 in the morning, I'm checking my emails and I'm looking for something else, and I see the statement from 11 days ago.
Yeah.
And I say, "Oops, I missed it again," and then go and pay it at 10 a.m. in the morning.
Yeah.
So later that day, towards the evening, I still get a text message.
Yeah.
After that, an email with a very frank language saying that we're so sorry to see that you missed your payment. Please do it as ASAP. We don't want you to, your credit bureau score to deteriorate and things like that.
Yeah.
So and an unhappy emoji at the end of the sentence and things like that. It looks very modern, but at the end, it takes just one intraday filter to see who made their payments.
Yeah,
before sending all those text and emails and everything.
Yeah,
it just takes a filter.
Yeah.
So you need to take a phased approach to use what sort of information about your customers and what type of analytical capabilities you will need to tackle each customer journey. So I'm coming back to this journey thing, because it could be a credit application, looking for something in the mobile app, or trying to increase your overdraft limit through the mobile app and things like that. Advanced analytics is the capability set that you have. It's not the target. It should be seen as the vehicle that will take you to your target.
Yeah.
So we mix this most of the time. So, but when you come up with the journeys correctly, like we mentioned, you're moving your house,
first,
getting a mortgage, for example.
Yeah.
You will see easily where you will need the advanced analytics piece.
Yeah.
For example, credit risk modeling. It has gone a long way from using simpler algorithms like linear regression, where you have maximum of 15 to 20 characteristics about the customer and they come up with the probability of default, to using explainable machine learning algorithms where you can use 300, 500 characteristics, insights about the customer, and still have a stable model in today's the advanced technology. So this is one of the places that you always search for improvement. Am I using the best model I can? How frequently can I retrain it and do not get criticized by the local authority and things like that? These are the places that you should go with the advanced analytics and things like that.
Yeah.
And getting back to your question, to find more niche customer segments within the data. For example, finding the fragile customers who will get hurt before the rest of the portfolio.
Yeah,
I think it's more about how you frame the business problem. If you how you frame the target definition of the predictive model. I mean, targeting any consumer that will go default in the next 12 months is something. but targeting the fragile customers that will default in the next 12 months is kind of different.
Yeah.
So there could be a couple of things that you can do. You can do separate modeling for different niche subgroups, like fragile customers in that case, or you can do one machine learning model which will take all the data, in contrary to what we were doing in linear regression or logistic regression. You need much more variable, different variables of data all together, and come up with a model and see if it works for your fragile customers, if it works for your new customers and older ones and all the sub segments, and then you act upon it. But of course, it doesn't end there. Once you are able to, thanks to advanced analytics, once you are able to pick up the fragile customers, let's say, you will need to address what to do with them in your decisioning process, for sure.
Yeah.
So
identification is only the first part of the process.
Exactly. Yeah. So to summarize, you will have the main strategies about your portfolio on the roof, right? As a lender, your guidelines about the portfolio. So your expected return on equity, your forecast regarding the NPS, non-performing loans, and how you should do the spread game in between. And to serve those guidelines, you come up with dozens of tools for a perfect risk and reward optimization. Your policy rules, scoring models, limit algorithms, and hundreds of action sets for different small micro segments. But you need to orchestrate all this in the best way possible. Advanced analytics is just a part of it, which is a very important part of it, but just a part of it. I think you need to orchestrate all this in the best way possible, preferably from a central model like Provenir, so that you can automate whatever you want, what to do with the fragile ones, when the collection amounts start to rise in your portfolio, or what to do with the least risky, wealthy customers while coming out of the credit crime.
That's the opportunity side of it as well, isn't it?
Exactly.
It's not just saving yourself money at one end, but how can we actually generate revenue on the other side? So no, that's good. I think if I was working with your bank, I think I would suggest one more potential solution for them based on customer behavior, and that's maybe the day before you're supposed to make the payment, send you a text message then and say, Hakan, do you want to make your payment?
They do that, to be honest. I'm not going to lie, but it sometimes helps, sometimes it doesn't.
It doesn't work. No, that's good. That's perfect. Cenker, anything you want to add to that before we move to the next question?
It's a shame on Hakan for being such a lazy payer. I mean,
banks used to love payers like Hakan because they were the most profitable ones, because they always did pay, but they always paid a little bit of interest every month. So they were the perfect customer. So
they couldn't earn as much as they could from me because I was always the employee of them. Now they started earning from me.
Yeah, that's good. Okay, so just to wrap up, so Cenker, just if you can share with us maybe some of the ways that you've seen to sort of maximize the interactions and growth at every stage of the customer life cycle. And, I think coming back to, what you've been saying all along, that sort of customer-centered experience.
I think the short answer is, utilize everything we have been talking about in the last hour or so. But it all starts with targeting the right audience, right? And in order to do that, you have to be able to use data analytics, segmentation techniques, and tailor
gone is the one size fits all. Yeah,
absolutely. And channel those right individuals into the right digital channels, utilizing online platforms, social media, search engine optimization, you name it. You reach a wider audience and drive traffic to the lender's website or mobile app. But also being able to personalize the application process. We talked about personalizing the individual experience or the product. But before you even offer the product, You can even personalize the application process by offering a seamless sort of experience across various devices.
And very basic
and then
things,
omni-channel
like
experience.
If I'm an existing customer, don't ask me things that you already know about because I'm your customer. You know, it's a very basic one, isn't it? Yeah.
You know, Hakan is gonna pay a day after the due date, right? So don't send that text to him.
Self-cure customer.
That's what you do.
Absolutely.
Yeah.
And maybe even provide a pre-approval option, right?
Yeah.
You're aiming to increase conversion rates and reduce application abandonment. Therefore, offering a pre-approval option, increases the conversion rates.
Definitely.
So once we onboarded the actual customer, right, we have to continue to invest in the relationship. So we have to establish a strong relationship. A positive and welcoming interaction is key. But also offering customers sort of an educational resource to maybe promote financial literacy is going to be really key.
Yeah, especially like you say, when economic conditions are changing so much, you know, being proactive about what can you do, Mr. Customer, to protect yourself, given what we're going through. Yeah,
or when you're aiming tin file customers, subprime, you name it. This takes me to my next point around offering cross-sell and upsell opportunities. So you have to be able to identify opportunities to introduce additional products and services. And also being able to enable like self-service options you can provide to your customers, helping them to track credit usage, make payments, access their statements, their accounts, empowering them, creating a sort of a community and loyalty aspect. So the next bit will be around monitoring the consumer behavior, right? It's about retaining those customers and the good ones, hopefully. So you have to be able to track the interactions, the account activity, the financial health indicators, and maybe identify potential issues early on and proactively intervene to prevent the churn.
Get your collections in first before everybody else's.
Absolutely. Rewards programs are important. Offering loyalty programs and rewards for timely payments and responsible credit usage, and coupled with that, offering value-added services as well. But what's most important is to be able to gather and act on consumer feedback. Using this feedback, you can identify areas of improvement and make necessary changes to enhance customer satisfaction. There's also another part of the customer life cycle, which I like to call advocacy. So actively engaging with your customers on social media platforms, responding to their inquiries and address their concerns promptly. Again, fostering a sense of community and loyalty. And last but not least, incorporating customer feedback and their suggestions into developing new products or services, right? Many companies these days build customer advisory boards and collect advice and recommendation and expectations from them to incorporate into their product roadmap. Why not do the same with your consumers? I think by implementing these strategies, the credit lenders can maximize interactions and growth throughout the customer life cycle.
Yeah. Thank you very much, Cenker. Thank you very much, Hakan. So I hope that spending time with us today, you've picked up some good hints and tips of how to win in difficult economic conditions, because that's certainly what a lot of the world is experiencing currently. And I would like to thank very much Hakan and Cenker for your time and for your inputs this afternoon. It's been great talking to you both. Thank you very much.
You.
And,
thank you, Corinne.
Bye-bye.
Bye-bye.
Bye, everyone.